Welcome to the debate. We are witnessing what feels like a critical juncture in global finance, and it stems really directly from domestic political failure here in the U.S. The government shutdown has triggered what analysts are, I think correctly, calling a data blackout. This has critically paused the release of key economic reports, most notably the monthly jobs report withheld from the markets. And this sudden information vacuum, well, it's leading immediately to rising uncertainty and certainly volatility in global markets.
That's right. The lack of that key NFP number, non-farm payrolls, it just throws a wrench into everything for traders, for policy watchers.
Exactly. So the core question before us, and this really emerges directly from the reactions we're seeing, is this. Does the tactical window created by this U.S. data blackout represent a meaningful, perhaps long-term accelerant in the structural erosion of the dollar's global standing? Or alternatively, is its impact merely, short-term market noise that will quickly revert once the information flow resumes? I'm going to argue that this cannot simply be dismissed as noise. I think the reputational damage caused by, unreliable governance, coupled with the tactical acceleration of non-U.S. trade, particularly by BRICS members and their strategic partners, fundamentally contributes to and frankly accelerates long-term de-dollarization. This event, I believe, makes the next crisis cheaper to exploit.
See, I have a different read on this. While yes, immediate market fluctuations are certainly visible, we're seeing traders scramble to price risk when critical metrics disappear, gold ticked up a bit, yields wobbled, I maintain that the structural resilience of the U.S. financial system ensures that these wobbles are fundamentally transient. This volatility is a pricing anomaly, really, driven by information scarcity. I expect it will snap back to baseline once data integrity is restored. The structural foundations, I argue, remain impervious to what is essentially a short political squabble.
Okay, let me lay out my position more fully then. My core claim is that the data blackout creates an information vacuum, right? And in this environment, uncertainty itself is effectively a currency that rival players can exploit. And we are talking specifically about the BRICS coalition and their allies, China, India, Russia, and key Gulf partners who are already quite committed to seeking alternative payment rails. Washington's distraction, it offers a tactical, low-cost opportunity to build out more permanent infrastructure for themselves.
An opportunity, perhaps, but how effective?
Well, this information vacuum allows diplomatic and trade moves to be accelerated or at least hidden from immediate, intense scrutiny. Think about finalizing energy deals invoiced in non-U.S. dollar units, or expanding local currency trade corridors, and crucially, negotiating currency swap lines. These actions create vital optionality for other countries. They decrease the institutional friction for non-dollar trade, and that, in turn, accelerates what was already a slow erosion model of the dollar's edge.
That's a compelling argument regarding opportunism, I'll grant you that. But the problem, as I see it, lies in the scale and the actual mechanism. While we observe these classic safe haven moves, yes, gold ticked up, some currencies softened slightly, this feels like purely short-term volatility. It's market noise, really, resulting from traders essentially guessing at the future direction of Fed policy, now that the jobs report withheld makes that harder. It's not a fundamental structural change in the making, not yet. A short shutdown alone, let's be clear, will not topple the dollar. Why? Because the institutional gravity of the U.S. financial system is simply too immense. The U.S. maintains control over the underlying global reserve infrastructure. It possesses the deepest and most liquid capital markets globally. And that unrivaled liquidity, that depth, is ultimately what reserve managers prioritize above almost everything else.
History shows, and most experts fully expect, a rapid market normalization, a reversion once the data resumes. This confirms, for me, that the fundamental advantages haven't really been altered by a single missing jobs report.
I agree that the underlying infrastructure is currently dominant, of course, but we really must look at the multiplier effect of perception. I think the greatest impact here is actually psychological. Global finance is predicated on predictable data and, frankly, reliable governance. When the world's supposed reserve currency issuer regularly demonstrates political instability so severe that it can't even release its core economic health indicators, Well, it forces central banks and sovereign treasuries worldwide to privately ask a very fundamental question. How much dollar exposure should we maybe gradually reduce?
A fair question for them to ask internally.
Right. And this question, repeated over time, not just during a crisis like this, but in the months and years afterward, it shifts long-term allocation decisions. It's a kind of model where damaged perception leads eventually to new allocation strategies, which then dictate long-term flows. It's not really about today's price of gold. It's about, say, a foreign pension fund adjusting its U.S. asset mix by just a few percentage points over the next 3 years. Those small adjustments, they compound. They erode the core market share over time.
I see why you emphasize perception, but I would frame it differently. While damaged perception is certainly a headache for Washington, no doubt, the primary decision drivers for those reserve managers, the ones making billion-dollar allocation choices, they remain the structural fundamentals. Liquidity is the ultimate defense mechanism here. Think about what we really mean by liquidity. It's the ability to sell, say, $1 trillion of an asset without the price completely collapsing.
Okay.
When global entities need to park truly massive amounts of capital safely, I'm talking hundreds of billions from sovereign wealth funds, for example, there is simply no viable alternative right now to the U.S. Treasury market. You cannot just shift those sums to, say, the Shanghai Exchange overnight. It's not feasible. The legal protections, the institutional depth, the sheer ability to exit a massive trade without causing major friction. These structural advantages massively outweigh the transient political distraction of a delayed jobs report. The volatility we see, it's an information risk premium being priced in, not systemic failure pricing.
But let's pivot slightly from the theoretical damage, the perception issue, to the tangible actions. If perception is suffering, even if you argue it's secondary, what are our rivals actually doing in this tactical window? I'm looking specifically at BRICS. Now, I'm not suggesting they can replace the dollar instantly. That's unrealistic. But this data blackout does allow for concrete, sometimes irreversible actions that build momentum.
What kinds of actions specifically?
For instance, we need to watch for specific things like energy contracts being finalized with non-USD invoicing clauses. That's concrete. Or, perhaps even more critically, announcements of central bank swap lines. For the listener, a swap line basically means two countries agreed to exchange their currencies directly at a predetermined rate, bypassing the dollar as the intermediary for trade settlement. The political cost, the scrutiny for making these announcements, is arguably significantly lower when Washington is visibly focused on its own internal crisis and global media attention is diverted. The source material we looked at highlights how different BRICS members can leverage their unique strengths: China's scale, Russia's energy leverage, the Gulf states' influence on oil pricing to accelerate these incremental building blocks of an alternative system.
That's an interesting point about the lowered political cost, though I need to push back significantly on the scale and the practical impact of these tactical moves right now. I agree BRICS nations are acting opportunistically, but can you really detail how the absence of one U.S. labor report specifically lowers the political cost of, say, a $100 billion bilateral oil contract that's probably been negotiated for months, if not years? It seems like domestic governance failure here is largely independent of that kind of long-term geopolitical deal-making cycle.
It lowers the friction for the final announcement, the final push.
Perhaps. Furthermore, the immediate, relatively small scale of these deals doesn't really constitute a systemic threat yet. These tactical moves, while certainly present, are severely constrained by the competing, often quite divergent interests of the disparate BRICS members themselves. Let's be honest, they don't represent a unified, cohesive alternative system ready to take over. The overall volume cleared through the dollar every single day absolutely dwarfs the total value of these bilateral swap lines or non-dollar contracts. Your acceleration model relies on these smaller actions accumulating. I get that. But they don't pose a systemic risk as long as the U.S. still controls the core institutional payment rails and the deep reserve infrastructure through which most major global transactions must eventually flow or be reconciled.
I'm compelled by your argument on institutional gravity. I really am. But I think we might be debating the speed of the car, not necessarily the ultimate direction of travel. The point isn't just about the size of the initial oil deal today. It's about lowering the future threshold for resistance to alternatives.
How so?
Well, the core risk, as I see it, is not this current shock alone, but the pattern. The idea that repeated shocks lower the threshold for change. When the dollar system is tested once, the cost of switching to alternatives, in terms of risk, complexity, political capital, is very high. But when this short shutdown, even if it's quickly resolved, contributes to normalizing political dysfunction in the issuer of the world's reserve currency, it makes future crises cheaper and easier for non-dollar alternatives to exploit. Repetition breeds doubt. Doubt eventually makes alternatives seem less risky, cheaper. Each time Washington falters like this, the cost of friction for pursuing non-dollar trade incrementally decreases. That's the long-term danger, the cumulative effect.
I absolutely concede that the risk of repetition is real. Nobody wants to see political dysfunction normalized. That's bad for everyone. But if we focus just on this immediate shutdown, the market reaction itself is almost a testament to the dollar's indispensable role, isn't it? The rapid rise in volatility precisely because the non-farm payrolls data is withheld confirms the global market's deep dependency on U.S. data integrity and policy clarity. You could argue this is the market pricing the temporary lack of the dollar-backed system's predictability, not its imminent abandonment.
An interesting inversion.
Right. The structural argument holds strong here. The immediate expectation, widely held, of normalization once data resumes fundamentally limits the lasting damage of this one event. The market reaction reflects standard risk pricing when key labor numbers are withheld. It confirms reliance on the system, not necessarily a collapse of faith in the underlying financial framework itself.
Okay, so to summarize my position then, this data blackout must be viewed as more than just a short-term market hiccup creating temporary noise. I see it as a critical vulnerability that actors like the BRICS members are actively using to accelerate the long-term erosion of confidence in U.S. governance and data predictability. This dynamic, I argue, accelerates the process of shifting long-term allocation decisions over months and years, even if the immediate market prices revert to their baseline. The cumulative damage is reputational and tactical, making the next attempt at de-dollarization fundamentally easier and cheaper for those pursuing it.
And conversely, my summary is that the structural dominance of the U.S. financial system, specifically the unrivaled depth of its capital markets and the established institutional reserve infrastructure, serves as a powerful, almost immediate brake on any opportunistic, tactical moves by rival powers. While market sentiment certainly suffers from this political uncertainty and perception takes a hit, the core financial mechanism is fundamentally resilient. Therefore, we should expect significant normalization once data integrity is fully restored, confirming that these tactical moves remain just market noise until and unless they reach a truly systemic liquid scale. And structurally, we are still very far from that threshold.
So this debate, I think, really illuminates the essential tension in global finance today, that push and pull between the immense, almost inertial power of structural foundations like the dollar system versus the accelerating impact of political uncertainty and damaged perception.
Agreed. The material we've looked at clearly suggests that while the dollar's immediate catastrophic fall is highly unlikely, the ongoing accumulation of these tactical, opportunistic moves by competing powers, especially against a backdrop of increasing political instability in the U.S., certainly warrants continuous and very close observation.